Hello, good evening.
Good evening, sir.
It's nice meeting you. How's been your day and the rigorous activities today? The Almighty God will favor our labor, will not labor in vain. Let's kickstart our lecture. So the earlier the best, so that we can finish on time. I always being considerate of the fact that tomorrow is another day. Online lecture, physical lecture, a lot of activities that we have to attend to. And that's one reason why I do stop my lecture at a reasonable time. I won't stress you to the odd hours. God willing, today we are adding another knowledge, another value, and I pray God will give you retentive memory and crown our effort with success. We shall
Amen.
succeed first coming exam. Okay, tonight, briefly, we are going to look at strategic clock analysis. Strategic clock analysis. Um, in conjunction with that strategic clock analysis, we mentioned Porter's principle of strategic position of a firm. The reason for that, I will tell you. So we are going to look at Porter 546 model. This one came out in the last exam. Porter 546 model, and that does not mean it cannot come out this forthcoming exam. It can come out to be set or asked in another strategic way. Porter 546 model. So after the Porter 546 model, so we will briefly discuss on the Porter's generic competitive strategy. The Porter generic competitive strategy. This one is 3, but now in application it has been extended to 4. Having looked at that, then we are going to look at mission and vision statements. That was fall under organizational purpose and strategy. We are required to dwell more on mission and vision statement of the organization. So after the vision and mission statement, then lastly we can look at the level of strategy. And by the time we look at the level of strategy, then approach to strategic planning. That one we take it together with that level of strategy. With that, we are done. Under 2 hours or more than that, or 2.5 hours or thereafter. So I can be able to release you so that I can relax and prepare for tomorrow's work lectures and attention to family, because we need work-life balance. So can we start our lecture now?
Yes,
Okay, we
sir.
have 17 learned colleagues in the house. Okay, we start by looking at Bowman strategic clock analysis. In the exam proper, there's no other name they will give it than to call it that using Bowman strategy, or they will put Bowman strategic clock analysis. So there is no way, there won't be any form of confusion in the exam. No other scholar discuss about this than Bowman, I think in conjunction with David Faulkner. Okay, what is the Bowman strategic clock analysis all about? So in summary, the strategic clock analysis just talk about how organization can create value to their customers. It's all about value creation. Because now that we are in the platform era now, digital economy, even before this platform era that we have, we discovered that during the orthodox method of marketing and strategic formulation, companies always strive towards giving value to their customers. And the only way we can give value to customers is by producing a product that meet and satisfy the customer's need and wants and expectations. So that value will come from price. The perceived value can come from quality of our products. can as well come from the brand reputation. The brand reputation, our goodwill to customers. How does the customer perceive us? So product reliability, customer service, innovation. These are form of values that we are talking about. So the Boma strategic clock analysis now, Faulkner and Boma now come up with a model. That model, they call it strategic clock analysis. The essence of that is that they want organization, you and I, to embrace and adopt this strategy. Because the strategy is thoughtful, educative, value adding, and to create a strategic pathway for company to achieve all their aims, satisfy customers, create value, and make profits. So Bowman said that this strategy that we are about to discuss about is a combination strategy. How come he call this combination strategy? He call this combination strategy because it requires the combination of price and any other strategy. So with that, we should know that price is constant as far as this model is concerned. You cannot add another strategy, but you have to compete, challenge your customers with the use of price and other strategy. So the scholar said there are 6 strategies that companies normally use and which they can use based on his own model. But out of these 6 strategies, he recommended 5. He said the last strategy, please, as an individual, SMEs, corporate organization, conglomerate organization, multinational company, avoid the use of the 6 strategies that he called 6 o'clock strategy. He said these 6 strategies, they had adverse significant negative effects on the company performance. And they can only give you short-term benefits. At the long run, it will affect you. It will weaken your competition, cause loss of customers, attract litigation, damage your goodwill. So we are going to look at all those strategies one by one. So that's what we are doing. So it's very, very simple. Let our mind be here. Let's avoid distraction. In some couple of minutes now, we know what we call the strategic clock analysis that ICAN require that we should know. These are things that we should retain, not just for the exam purpose. Okay, we can start. The strategic clock analysis. The strategic clock analysis was suggested by Bowman 1996. And it was suggested as a way of looking at combination of price and perceived benefits. So when we use the combination of price and some other strategy, what are the benefits that the company deserves to gain? So this approach assumes that competitive advantage, please note, competitive advantage is achieved if a firm supply customers want better than its competitors. That is one of the premises that this model rely on. He said this approach assumes that competitive advantage is achieved if a firm supply customers want better than its competitors. So if we can be able to produce a qualitative product, a unique product, and services, and these services create positive satisfaction to the customers that we call cognitive consonance. He said the customers will come to us, they will make referral. It will make us to perform better than our competitors that produce inferior products or competitors that their product cannot meet the expectations of the customers. So we proceed further. The scholar said that customers want consists of combination of cost and quality. So we can see that cost as price. So the customers want, they are ready to pay a premium price for a quality product that will render significant and favorable experience for them. So customers one consists of combination of cost and quality. So what are the purpose of the strategic clock analysis? We are moving gradually now. The two key factors in providing the value to customers are the price of the products or services and the benefit that the customers believe the product or services will provide. He said these are the two key factors that provide value for customers: the price of the product and the benefit derivable from that product. It's like buying a ceiling fan. When you get home, you call an electrician, they fix it, and by the time you on it, it's not providing a cooling effect. It's not oscillating. At times when you on it, it will not start. You have to climb a ladder or shear, or climb the bread to first of all force it for it to rotate. That means there is no value for the money that we have spent. So the scholar says that competitive advantage comes from offering an attractive combination of price and perceived benefit. So having know all these the preliminaries now, we can now proceed proper in moving to the strategic clock analysis, because I don't want to rush it at all. Drawing a strategic clock analysis. The drawing for the strategic clock analysis is what we are seeing below. There's the drawing. You can see that the S-axis we have the perceived product or services benefits, that is value, and our y-axis we say price. So in drawing the diagram, you can see that the diagram look like work clock. That's the reason why they call it strategic clock analysis. It look exactly like work clock. The number one thing that we have, number one strategy in that diagram is no frills strategy. That is number one. NOFRILLS. That is 1 o'clock strategy. Since we assume that this diagram is synonymous to clock, that number one strategy is 1 o'clock strategy. We call it no frills strategy. Number two strategy in the diagram is low price strategy. While the number three strategy is hybrid strategy. Number four strategy, differentiation strategy. Number five strategy, focus differentiation strategy. And you want to bring differentiation first, that means differentiation focus strategy is still the same thing. I'm saying it because if you see it in another literatures or textbook or material, so you can call it focus strategy or differentiation strategy. That's number five. Number six strategy, that is 6 o'clock strategy. We call it strategy that fails. In some textbooks, they will call it strategy that offer no benefits. This is the strategy that the scholar, Bowman and Faulkner, say we should avoid the use of number 6 o'clock strategy that fail. So the strategy that we talk about in the diagram are this. The 5 broad groups of business strategy that provide competitive advantage, according to Bowman, are 1, no frills strategy, that is position 1 on the clock. 2, low price strategy, position 2 on the clock, that's 2 o'clock strategy. 3, differentiation strategy. 4, hybrid strategy. 5, focus differentiation strategy. And the number 6 that you know is strategy that fail. So I decided not to put it here because the scholar have said we should not use it. And when you look at our heading here, we said the 5 broad group of business strategy that provide competitive advantage. That means strategy number 6 did not give us any advantage. That's the reason why I don't put it here. Okay, what do you mean by no frills strategy? No frills strategy. That is position 1, 1 o'clock strategy. A no frills strategy occur when a company produces a below average quality product and sell it at lower price. That is the meaning of no frills strategy. In fact, in some materials, study materials, even in ICAN materials and some other online material textbooks, literatures, we can have this no free strategy that they will discuss is using about 6 pages, 7 pages. The simple meaning that you just have to know about the no free strategy, irrespective of the pages, is that a no free strategy is to offer a product or services at a lower price and with low perceived benefits. So a no free strategy is a strategy that the company adopts when they sell or offer a product or services of a lower value at a lower price. The customers will perceive the product as a low quality product, but it's a basic product that they need for sustainability of life. They don't have the money to buy luxury products. They are sensitive to price. So due to that, the customers will prefer a situation whereby they buy so the customers will prefer that since the product can offer them benefit required, so it is better they buy that low but with lower quality. So a low free strategy occur when company offer a below average product to customers at a lower price. And this strategy that you are seeing, it is very, very good as a strategy when there is inflation. When there is inflation. 2, when a company produce a segmented product, the strategy is good because we can have a situation whereby we have some customers that cannot afford our high price products that will skim the price because of their quality and size. So we can now decide to produce another product that is of lower quality and with lower price. Even some companies are doing it intentionally for them to gain market leadership position. It occurs, be it in the manufacturing industry. It is very common in the airline industry too, whereby some companies, airline company will decide to make available some of their services at a lower price as compared to some of the existing competitors. So before we move to the second strategy, let me re-emphasize. A no-free strategy is to offer a product or services at a lower price and with low perceived benefits. So this strategy is to attract customers who are price conscious and are happy to buy a basic product at the lowest possible price. So the strategy has been used by low-cost airlines and some other companies in other industry. Okay, the second one is low price strategy. Position 2, that is 2 o'clock strategy. With a low price strategy, customers perceive that the product or services give average or normal benefit. Can you see the difference now? That means the quality of the product that we are selling in position 2, the quality of the product is higher than that of the position 1. So in position 2, low price strategy, we still maintain that our pricing strategy. That means in that industry or market, the company is competing offensively. They are using price as a weapon to win customers, gain competitive advantage, and frustrate other existing suppliers or sellers in the market. So they maintain that lower price. It is that lower price that is giving them leadership in the market and ability to win more customers. So low price strategy occur when a company sell an above average product at a lower price. I call it above average product because the product quality in number 2 is higher than that of number 1. And for you to do this, you know that we have to ensure that we streamline our operating or operational costs. Because we have it here that only the lowest cost producer in the market can implement this business strategy. If your operational cost is high, then automatically you cannot use low price strategy. It will be difficult to break even, not to talk of making profits. Number 3 strategy, hybrid strategy. That is a 3 o'clock strategy, position 3 on the diagram. What do we call hybrid? Anywhere we see hybrid, hybrid means 2. That's the meaning of hybrid. So a hybrid strategy involves selling a product or services that combines higher than average benefits to customers and at below average selling price. So before we can call it hybrid strategy, it must require a combination of 2 strategies. You know, from the onset, I told you that the scholar, that is Bowman and Faulkner, he told us that the strategy is called a combination strategy because it requires the use of price and other strategy. And that is exactly what we are doing in position 3. Hybrid, 2 strategy, but your price must be constant. So hybrid strategy will require the use of price and any other strategy of choice. It can be product differentiation, price and product differentiation, price and free delivery, price and extra, any strategy of choice. That's what we call hybrid strategy. And for you to know it is hybrid strategy, look at the last statement that we have in that paragraph. It said the hybrid strategy try to achieve a mix between a low price strategy and a differentiation strategy. And despite the fact that we differentiate the product.
Okay.
Hello?
The page is not moving, no. We are not seeing.
I'm not seeing the screen.
We are
Okay,
seeing,
thanks
I
for
can
that.
see it, but it's not moving.
It's not moving.
Yes, we can't follow what you are saying. We're only in
You can't follow. Okay, let
position
me
1 up
reshare
to
this.
now. We are only seeing
Okay.
position 1.
Okay. I've reshared the slide now. Thanks for that observation. Hello, can you see it now?
We are seeing this slide. Is that the slide is not moving? We are not seeing the
The
pages
slide is
you are
not
reading.
moving.
Exactly. We are not seeing the pages you are reading. So that's
Okay. Like this. Is it moving like this? Hello?
no, sir.
No, sir.
It is still at the 5 broad group of business.
Okay, it is still at that 5. Okay. What will have been the cost of that? Let me quickly fix that. Let me fix that. I'm coming. What will have been the cost of that now? Okay. Is it moving now, please?
No, sir.
What is happening?
Maybe you stop sharing and reshare.
Okay, let me stop sharing and reshare. Okay, thank you. Okay. Hello, I've reshared it.
Yeah, it's moving now.
It's moving. God bless you. So where should we continue? Position 3 or 2?
Position 3.
Position 3. Okay. Thank you. So the position 3 is called hybrid strategy. And I inform you that hybrid means 2. That means what should come to your mind is that the company should at least use minimum of 2 strategy in position 3, 3 o'clock strategy, since hybrid means 2. And the scholar inform us, Bowman and Faulkner, they said the strategy is a combination strategy that involves the use of price and any other strategy to create value. Then here, we are to advise whatever organization they use as a case study, that at least that the company can adopt hybrid strategy by offering their product as a reasonable price, that is lower price, and differentiate their product or service delivery. Because look at the statement that we have here. Let's read through it together, but the class will be interactive. A hybrid strategy involves selling a product or services that combines higher than average benefit to customers and at below average selling price. So for this strategy to be successful, what are we to do? To be successful, this business strategy requires low-cost production and ability to provide larger benefits. Above all, what do we call hybrid now? Hybrid strategy try to achieve a mix between a low price strategy and differentiation strategy. And it's not compulsory to be differentiation strategy. You can have another strategy that the company can implement, but price must be there. And please, this low price does not mean that we should sell at a loss. The low price means we sell at a reasonable price, moderate price, or affordable price. So hybrid means 2 strategy. Position 4, differentiation strategy. Differentiation strategy, what does it mean? A differentiation strategy is based on making a product or services appear to offer more benefits than rival product or services, which means we offer a product or services that the customer perceive different from other existing products. That product, they perceive it different, they perceive it unique. They're able to see some features or benefits that they have not been deriving from other existing products that the customers have been buying. And the implication of this is that anytime the customers differentiate their service or product offer in the market, the customer don't mind spending more, buying it at a higher price. So that will give the company an opportunity to sell at a premium price. We sell at a premium price to add value to the product or service, to recover our cost of investment, to make quick return on investment before other competitors will imitate the product. So we are differentiating this product to make them new to customers. And this product differentiation, it can be a new innovative product, or we try to add more quality, more value to our existing products. So we relaunch it to the market and the customer perceive it as something new. But that product must offer value. It must have something different from all other existing products. And we have the opportunity to sell it at a higher price. That higher price in exam, they will use the word premium price. We are still going to look at a lot of past questions before the exam. The number 5 strategy, that is focused differentiation strategy. The difference between number 4 strategy, differentiation strategy, and number 5 strategy is that the number 4 strategy, that product or service offer is for the entire market. We are not focusing on any particular niche in the market. But in number 5, you can see the word focus differentiation strategy. And I told you can call it differentiation focus strategy. The company produces innovative and differentiated products, but that product is not meant for the entire market. The product is tailored for the purchase and satisfaction of specific class of customers. That's the difference there. So look at it. A focused differentiation strategy is to sell differentiated and innovative products that offer above average benefit for a higher than average price to who? Specific class of customers, such as first class airline, such as how would I call it? Personal banking services. We differentiate that product and it's meant for the consumption of specific class of customers. It's like building a school for physically challenged pupils. The modern school is a physically challenged school, so it's not meant for everybody. And we offer that service at a premium price, higher price. So the products in this category are often strongly branded as premium. You must sell it at a higher price, but that's the only way you can add value, recover your cost of investment, and make profit. So number 6 strategy, 6 o'clock strategy. The 6 o'clock strategy are business strategy that fail. We advise that we should not use this strategy. Don't move closer to it. In fact, don't be tempted. If we see others that are using it, we must not imitate them, copy that strategy. So the diagram of the strategic clock show above indicates some business strategy that will not succeed because they did not enable the company to gain competitive advantage. It will just give you immediate, how would I call it? Immediate gain, short-time benefit. But at the long run, it will create a negative effect and crisis for the company. So what are the examples of this strategy that fails? 1, price fixing. Price fixing or price cartel occur when we have 2 or more suppliers that come together to fix a price in order to cheat the customers and force some of the existing customers, chase them away from the market. It's an illegal pricing strategy that is punishable under law. And once this is known to the customers and other investors, you know the implication. Another good example of business strategy that failed is hoarding of goods. When you hoard goods and services, we all know the motive of doing that, with the mind of creating artificial scarcity and increase the price to exploit the customers. This one attracts litigation and punishment from the government and even customers who will not patronize you again. Tax evasion is there. Selling of obsolete products, expired products. When you are selling it without thinking of the health and safety of the customers. Overpricing of low quality products to the customers and greenwashing. Just to mention few. There are many. Greenwashing is among the business strategy that fail. What do we call greenwashing? Greenwashing means fallacious claims, disinformations, misleading advertisements, falsehood marketing strategies. Like a company that did not carry out CSR and they are lying to the government and the public that they carry out CSR. It's greenwashing. Play smooth.
How to make this on your paper?
Play smooth.
Oh,
Is that how they
it's
want
not
it?
connected. It's okay.
Okay, having a look at that position number 6, Michael Porter now advises us that there are 6 principles of strategic positions that organizations must consider for them to achieve sustainable competitive advantage. Because the whole idea, the aim of using strategic clock analysis is to create value and achieve sustainable competitive advantage using price and other strategies. So Michael Porter now says that any company that aims to achieve sustainable competitive advantage, there are 6 principles that they must follow. And that 6th principle is what we call Porter's 6 principle of strategic position for achieving sustainable competitive advantage. What are the principles? Let's quickly look at the principles. So principle 1, the principle 1 says that the strategic goal for a company should be to achieve a superior long-term return on investment. With that, Porter has nailed it. He said, anytime you are formulating your goals, our priority is to achieve a superior ROI, return on investment. He said, because the objective of going into business, investing into series of portfolio of investment, is to make returns so that we can be able to achieve further growth, pay dividends to the shareholder, meet the expectation of the shareholders, expand, diversify our investment. He said the only thing you can do to achieve that is by adhering to this principle 1, that the strategic goal for a company should be to achieve a superior long-term return on investments. Now I see another advice here. Look at this. A company should not select as its strategic goal any other objective, such as maximizing sales volume or maximizing market share. He said you should not just rest on the assumption or premises that you want to focus on increasing your sales volume or maximizing your share, market share. It said it is not at all time that increase in sales volume or market share will translate into high profit. And I agree with him. So he said maximizing sales or market share does not necessarily provide a superior return on investment. So we must have a goal and formulate a strategy that will give us opportunity to make high return on investments, high profitability, high return on capital employed, that is ROCE. Okay, if that is understood, what does the principle 2 says? The second principle says that the strategy must offer a unique value proposition for the customer. Any strategy that we are using, that strategy must be a strategy that will offer value to the customers. Must be a strategy that will offer satisfaction to the customers. Must be a strategy that will meet the expectations of the customers. It mustn't be a strategy that is dubious or strategy that will create dissatisfaction or make the customers to regret ever buying our products. So he said the strategy must offer value proposition for the customer. And this is a combination of price and benefit that competitors will not offer. That means to do this, to provide that value, we must provide it by using our price, setting at a reasonable or moderate price, and creating other benefits to the customers. The third principle says that there should also be a distinctive value chain distinctive value chain. We must ensure that other activities, other products and services that we produce and other competitors produce. But when you look around the industry, we discover that nearly all the companies produce either similar, slightly differentiated, non-differentiated products. But despite the fact that our products and services are the same, we have to ensure that we do it in a way that we offer value to the customers. We do it in a way that the customers will perceive our products as value adding. In number 4 principle, what does it say? Number 4 principle says that the selected strategy will involve trade-off. Very fantastic. He said the selected strategy must involve trade-off. That it is not, we must not ensure that we use multiple strategies all because we want to achieve our goals. We must have ability to evaluate all the strategies at our disposal. Any strategy that will not give us achievement of our goals, or any strategy that does not align with the objective of the company, should not be selected. You should be able to use fifth strategy that will give us results. We should be able to have a strategic options that the customers will know us for, what we stand for. So this means that by selecting one set of strategic options, a company inevitably chose not to select alternative options. Let me give you one scenario here. There was a time I can set a question using the airline industry, and the name of the company that they used as a case study was Air Spirit Limited. This Air Spirit Limited, they use the 5 strategic clock analysis. The only strategy they don't use is position 6 strategy. Apart from that, the company stick to all these principles. And it was asked in the exam that we should confirm, evaluate the strategy used by Air Spirit Limited. And we evaluated it. We discovered that the company used no free strategy, low price strategy, hybrid strategy, differentiation strategy, but the differentiation focus strategy was not used in that case study. But the company intends to use it in the future when they diversify. Is that understood? But all these principles, they use it, including this principle number 4. I want to cite that principle 4 for you as an example. In that case study, the company have a trade-off of strategy in that they don't attend to individual customers. No, they attend to a group of customers, and that group of customers must not be more than 20 in number. Another trade-off that the company adopts is that they don't take customers to pilgrim. Be you are going to for Hajj or you are going for JP Jerusalem. No, they don't do it. That's a trade-off. And that is exactly what Porter is saying here, that the selected strategy will involve some trade-off. This means that by selecting one set of strategic options, a company inevitably chose not to select alternative option. I assume that is understood. Number 5 principle. All the different elements in the strategy and the value chain should link together. We should align all the strategies together. And all the functional units or departments, all the staff, from the corporate, middle, and lower level, they must work as a team to achieve a collective goals. So all the different elements in the strategy, we should use them towards creation of value, satisfaction, and making profit. So while the last principles does talk about continuity, it shouldn't be one trade-off strategy. No, it should be something that we are doing persistently, continuously. What does the principle says? The principle says that there should be continuity of strategic direction. We must not lose focus. You must not allow strategic derailments So having chosen the strategy and the direction it wants to take in business, a company should apply the strategy consistently. So which will be known for that, what we stand for. But if you use the strategy today, tomorrow you try another strategy, next tomorrow we put another strategy, it might backfire. There should be consistency in the strategy that give us results and success. So that's what the Porter 6 principle says, that for any company that wants to use strategic clock analysis, you should be able to understand that 6 principle and implement it. So the second topic that we are looking at tonight is Porter's 5 forces model. Porter's 5 forces model that we popularly call the Porter's competition analysis. Porter 5 forces model is popularly called Porter competition analysis. Very, very simple. This Porter competition analysis, it is very essential we know it because it comes out in exam. For some of us that are going to write case study, this diet, even if you are not writing this diet, if you are not writing this diet, if you are writing this next diet, the Porter's 5 forces model is very, very key. You will need it in exam. But there's no way they are going to give you a case scenario that they are not going to talk about the business environment in which the companies operate. So this Porter 5 forces model and the environmental analysis using PESTEL model, they are very, very key. You will need it in exam. Okay, let's look at the Porter 5 forces model. The Porter 5 forces model, is a very popular and useful framework. Why is it useful? Because it is used to analyze industry attractiveness. And what does industry attractiveness mean? The industry attractiveness refers to how easy a business will find it to make reasonable profits in a particular market or industry. Because if the industry is not attractive, I will not advise you and I will not advise any organization to invest in such industry. Any industry that is volatile, any industry that is existence of monopoly, it is not advisable to invest in such an industry. So any industry that provides a reasonable profit is an attractive industry. So by reasonable profit, we mean profits large enough to compensate investors for their risks they have taken, and also to make enough money to reinvest to keep the company successful. I've justified the meaning of the attractiveness of the industry and profitability that we are talking about. So Michael Porter identified 5 factors or forces. Normally they will call it 5 forces model in exam. They can say using Porter's competition analysis model. Or the examiner can say using Porter 5 forces model. So that 2 words can be used interchangeably, please note. So Michael Porter identified 5 forces model that determine the strength, attractiveness, and nature of competition in an industry. So these forces are, number 1, threat from new entrants. I will tell you the meaning of that. Number 2, availability of substitute products or services. Number 3, bargaining power of suppliers. Number 4, bargaining power of buyers. Number 5, rivalry among major competitors. So I'll take that again. The 5 forces model of competition analysis are threat from new entrants, to availability 4, but 5, rivalry among major competitors. So we're going to look at this one by one for better understanding. So the first one we are looking at is the threats from new entrants. New entrants. NEWENTRANT. New entrants. Who are those people that we call new entrants? Before we proceed further, we must first of all understand the meaning of new entrants. So the new entrants are potential competitors, new sellers, suppliers, or companies that presently they are not selling or operating in the industry is attractive and profitable. So these new entrants, they are striving, making spirited efforts, using all available channels and strategy to ensure that they enter that profitable market. So potential sellers, competitive entrants. Okay. The threats from the new entrants now, we move together. One of the 5 forces is the threat that new competitors will enter the market and add to the competition. Meaning that the new entrants are potential competitors that want to enter the market. They are coming with their own new products that offer the same benefits like our own, or that might even offer superior benefit than our own. These new competitors, when they enter the market, they are adding more to the competitive pressure. Because if the existing company selling in the market at 12, additional 3 enter, that means it makes it 15. They are not coming to that market to pray for us or to buy our products. They are coming there to create more tension, more competition, to sell their own products, reduce our market share, reduce our sales, snatch our customers. That is what the new entrants are coming to do. As a result of that, Michael Porter says that these new entrants, they are poisonous to our business. And as a result, we must not allow them to come into that competitive market. He said all efforts must be put in place to ensure that we discourage or prevent the new entrants from coming to the market, because they don't have any positive value they will offer to us. So Michael Porter now says in this number 1, under the threat of new entrants, that we should place a high entry barrier. We should ensure that we place a high entry barrier that will discourage all new entrants from entering the market. Though, he said, no matter the level of barrier that we put in place, some new entrants will still be fortunate to enter the market. There might be sudden emergence of some of these new entrants in the market, like the way Amana, the producer of Right Gala, Biggie Gala, entered the market in the carbonated drink. And when you look at it now, we have not only Biggie Cola, we have RC Cola, we have American Cola. These are newborn baby. These are new products that are produced by new competitors. So they are coming to create a challenge to Nigerian Bottling Company, the bottler of Coca-Cola. They are creating challenge for 7-Up Bottling Company that produce 7-Up and Pepsi. So exactly what we are saying. So what I said, to limit the threat of competition and to avoid erosion of our sales and profitability, we must place high entry barriers to discourage some of the potential competitors. He said, if you place a high entry barrier, it will reduce the number of new entrants that will emerge eventually. But in a situation whereby we don't place any barrier, there will be influx of new competitors. They just be coming in, because there is no barrier to checkmate them. I hope that number one is understood. So the new entrants are new competitors vying to enter the market to sell their own new products. Porter said, new entrants are poisonous to our business. We should discourage them from entering our market by placing a high entry barrier. He said the high entry barrier will bring about low emergence of new entrants. So apart from the barriers that the existing competitors put in place to discourage the new entrants, another important thing that we must know about these new entrants is that the new entrants too, they have some factors that they consider before they enter any market or industry. No matter how attractive the market is, if all these factors are not favorable, they will not enter. They will wait for the time those factors are favorable. So what are these factors? The factors they consider are, these are the factors they consider. The major barriers that determine the emergence of new entrants. One, economic of scales. Without economic of scales, it means that if the new entrants will not have the opportunity to produce in large quantity, mass production, there's no way they can break even because they are coming to the market for the first time. If the market they are selling to and the available number of customers are small, available number of customers are small, then automatically they will be discouraged from entering the market. So because the economic of scale are reduction in average costs that are achieved by producing and selling an item in larger quantity. So once you can be able to produce in larger quantity, we all know as an accountant, it will give us opportunity to leverage on that and recover all our costs, fixed costs. We recover it quickly because we have larger markets, large number of potential customers that will buy our products. So if there is no opportunity for economic of scale, they will not come. Two, capital investment requirements. This is another discouraging factor, particularly for a company that is not financially buoyant. In some industry, like that airline industry that we mentioned, the financial capital outlay required is very high to operate airline industry. So this one is more or less a natural barrier on its own, high barrier that will discourage potential customers from potential competitors from coming, because it requires billions of naira of investment to establish yourself in the airline, even the maintenance, meeting the very stringent government regulations and the rest, and the risks attached to your investments. If the risk is high, the capital outlay is high, the government regulation is high, they will be discouraged. Number three is access to distribution channel, particularly for companies that produce fast-moving consumer goods. Some of them, they always have challenges in that some of the distributors might not be willing to accept their products at the infancy stage. Some of the existing distributors might have signed bonds. Some of them want to reduce their financial commitments or losses on a new brand that has not been established. So if there is low acceptability by existing distributors and market intermediaries, it will discourage them. But if they see a situation whereby large number of the marketing intermediaries are willing to support, stock, and sell their products, they will intensify effort to enter the market. Another important thing is time to become established. You might have found out the research and discovered that there are some strong brands in the market. Strong brand in the market. Let's assume we are talking of Zenith Bank, we are talking of Access Bank, we are talking of First Bank, we are talking of other powerful banks, UBA Bank and the rest. So a new bank that wants to emerge now, we now look at it that what is the duration of time to take us for our bank to be established, for this brand to be known, These are the challenges that the likes of Global Bank and some other banks that their branch is unknown. So in some industry, for a newcomer that is coming to sell their products, it gives them a lot of concern that if they have looked at it that it will take a longer time or decades for them to achieve brand recognition in the industry, they might not come. I put one example here, such as the fashion industry. No, we all know some brands have been in existence for decades. They are still the leading market industry up to now, up to tomorrow, possibly till Jesus come. So there are new brands that produce quality products too, but their brand name is not established. Their trademark is not known. And we are spending costs. So we have to consider the time frame for the brand to be established. Another important thing, and one of the most important factors that the new entrants will consider is this: switching costs. Switching costs. Very, very important. And you and I, we are considering that in all our purchases, and particularly when we are buying unfamiliar products. The switching cost refers to the cost, the price at which the company will pay for buying a new product. Let's assume we have been buying Milo or Bonfita before. Probably the price is, depending on the kilogram that we are buying, if the price is, let's assume the price is 3,500 naira for a refill sachet of 50 kg, just an assumption. That of Bonfita 2, 3,500 or 3,400. And we have been buying this for many years. We are enjoying value, no regrets for our purchase decision. A new product that is just launched, they want to sell it 5,500 naira. Because they are even launching the product during this harsh economy. They are launching the product during the inflationary period. So their cost of operation and many things is high. The intent selling is 5,500. And this is a product that we have been buying a leading brand, 3,500, 3,400. You can see that the switching cost is high. We are spending additional 2,000 naira to buy a newly introduced product. When this one occurs, it discourages existing buyer in the market. They rather stick to the product they have been buying, has been giving them value, than putting additional 2,000 naira to go and buy a new product that they are not even sure of the value or the satisfaction they will derive. The soft drink that we are buying in the market now is 500 naira. All these carbonated drink, 500 naira. Coke, Pepsi, and the rest. If a new product now is being launched, and it's not a differentiated product, say the same taste, and they offer it as 1,000 naira. Large number, millions of customers will not buy it. Some might even be considering, people like me that, let me just buy my Pepsi. The additional 500 naira, I'll use it to buy gala, rather than buying one soft drink, 1,000 naira. So when the switching cost is high, it discourages potential customers in buying a new product. And this will discourage the new entrant from launching their products. But if they are fortunate that they are able to embark on mass production, reduce their operating costs, secure raw materials at a lower price, they want to sell at existing market price. This one might bring about a sort of brand switching by customers, because we offer it the same price at which other competitors are selling. Or if there's another strategy that we can use, like that Biggie Cola that I mentioned. Biggie Cola use what we call non-pricing strategy. They use non-pricing strategy. How? They sell at a existing market price, but they increase the size of the bottle. So they compete using size as a strategy. Again, another discouraging factor that might discourage a new entrant that they consider very crucial is government regulations. Any industry where there is stringent government regulations, investors don't like it because the level of risk attached is high. There will be so many documentation, so many rules, so many governance, so many code of corporate governance that you have to follow. Violation of this thing might attract litigations. Existence of monopoly. The system of monopoly discourages the entry of new entrants in all industry. It is not peculiar to one industry. When there is existence of monopoly, well, it is the monopoly that will determine what to produce, the quantity of product to sell, the price at which to sell. They might even decide not to sell. So when there is a monopoly or when there is a market cartel, so all these factors are the factors that the new entrants consider before venturing into any industry. If those factors are favorable, they will move. If they are not favorable, they will not move. Number 2 factor. So what is the second force in the important 5 forces model? The second one is threat from substitute products. That word substitute products means alternative products. If you want to use the word alternative product, is okay. Nobody will penalize you. The threat from substitute products. That threat from substitute products simply means availability of alternative or substitute products. Why is it a threat? It's a threat. Let's see. There is a threat from substitute products when customers can switch fairly, easily to buying alternative products. If the customers don't have room for choice, they will buy available products in the market. Maybe probably our product and some of the few, let me use that word few, existing products in the market. But in a situation whereby other competitors now enter the market and introduce similar products that offer the same benefits, probably they even sell it at a lower price or they sell it at our own price. There is high tendency that some of these customers will make a trial purchase. They might have been exposed to so many adverts on these new products. Some people will make referral to them. Word of mouth recommendations are minimum. Unsolicited adverts on their phones, on TV. So that one will force them to go and make a trial purchase. And by the time they make a trial purchase, their expectation might be met. Maybe in time of price, in time of taste, they are not coming back to us. We are losing them. So anytime there is availability of a substitute product, it causes loss of customers, reduce sales, and reduce profitability. And like I mentioned that now that we're in a platform economy, it creates a lot of alternative products. Look at this example. Domestic heating system. Consumer might switch between gas fire equipment, oil fire equipment, and electricity fire heating system. In the transport system, what are the alternatives? Customers might switch between air transportation, rail, and road transportation. In consumable products, like what do we call the food and beverages, customers might switch between Bonfita and Milo. In the financial service industry, financial institution, customers can switch between or among banks. In the insurance industry, customers can switch between or among various insurance companies. Is that understood? Because there are various alternatives. Even in ICANN, I said students can switch between online lectures and physical lectures. There are a lot of students that are switching to equity because of the remarkable achievement and results. Our students are finding it easy to pass, and we have been giving glory to God for that. And yours will not be exception. I declare a landmark success for you in this exam and all your endeavors, including my very self and the management. So when there is a threat of alternatives product, the consumer can switch from one product to another. And that one is not favorable to existing competitors. In number 3, bargaining power of suppliers. You can see that bargaining power. Bargaining power just means the advantages that the suppliers gain. Don't mind the word bargaining power. Very simple. Let me simplify it for you. Bargaining power. Maybe 1 or 2 lines here. We explain it to you. I will now further give you examples. In some industry, suppliers have considerable power. You can see. Suppliers have considerable power. Like refinery industry. Now, NNPC have considerable power. Dangote have considerable power. In the fast-moving consumer goods, the likes of Dangote Group, Nestle PLC, Bois, Flour Mix, Cadbury, name them, USC, they have considerable power. And where does this power come? And what is the meaning of this power? In some industries, suppliers have considerable power, and when this occurs, they must charge high prices that firms buying from them are unable to pass to their own customers. That means when they have established brand name, their product is enjoying brand equity, they perceive it as a valuable product. It may give them opportunity to charge high price. At times, if they don't charge high price, they might determine the quantity to sell. So anytime the consumer or the suppliers have high bargaining power and they charge high price, it will reduce the profit that the intermediaries, retailers, wholesalers are making. So suppliers can gain high bargaining power when they are innovative. Those companies that are innovative, those companies that their products and brands is a leading product or brand in the market, they have high bargaining power. Those companies that produce differentiated products that render qualitative service delivery, prompt attention to customers, they are among those companies that gain high bargaining power. And when they gain this high bargaining power, the implication of it is that no customers will influence price for them. They will not be at the mercy of the customers. And they are going to gain a very strong competitive position in the market. You can see it tomorrow. The light of DHL, despite the fact that we have so many dispatch rider in the courier services now. Even we can't compare DHL with our own NIPOS. DHL have high bargaining power. So in all industry, the banking, construction industry, the manufacturing industry, food and beverage industry, fast-moving consumer good industry, name them. There are some companies that they have high bargaining power. The same way we have companies that have high bargaining power is the same way we have some customers or buyers that have high bargaining power. So the reverse is the case. When you look at the bargaining power of the buyers or the customers, under this one, the customers have high bargaining power. And as a result of that, companies must ensure that we manage these categories of customers. We must not lose them to our competitors. We have to ensure our negotiation with them should be a win-win negotiation. Because anytime the customers have high bargaining power, in most instances, they will be the one to dictate the price at which they want to buy. They will be the one to dictate the quality. At times, they might even be dictating the mode of payment. But the high bargaining power now put them in a situation whereby we consider them as the categories of customers that we must worship. A good example are all these major dealers, wholesalers that buy in bulk from companies. They finance the production of certain products or operation of the company. High bargaining power customers, they are VIP. Some banks worship some, what's it called? They even have a name for them. All these politicians, serial entrepreneurs that bank with them, they have billions of naira. So anytime they seek for one service or the other, anytime they decided to seek for loan, prompt attention is given to them because they are valuable assets to our company. I must have a way of managing all these powerful and superior customers. But by the time you lose one of them, it might affect the company. It might crumple our business and profitability. And from one powerful customer that we lost, another one might follow suit. So that's the more reason why anytime customers have high bargaining power, we must ensure that we manage such customers. Now, the time I give a scenario on this to some of my students under the high bargaining power of the customers using a school. I use the illustration of a private school that due to the economic situation, they have been contemplating to increase the school fees and other services they render to the pupil. But this new session that they want to resume now, no time, they now increase the school fees, maybe by 40%. So this does not augur well with a lot of parents, but they pleaded to them, they appealed to them that considering the situation of the thing, the overhead expenses, inflation tax, and many things. So please, they should accept this. And many parents accepted. But we now have a parent that have 2 or 3 people in that school. One in creche, one in nursery, another one in secondary school. And they are the same father and mother. They have high bargaining power. The school is not ready to part with them. They can negotiate with the management. And they will give them a subsidized price. Highest, they will beg them that, please, don't let it be known to other parents. So they have a high bargaining power. So that's the meaning of bargaining power. So the bargaining power can be gained by the customers, like I told you, when the following conditions occur. So Porter suggested that buyers might be particularly powerful in the following situations. 1, when the volume of their purchase is high relative to the size of the suppliers. But some dealers are even bigger than some companies. 2, when the product of the rival suppliers are likely the same. What we are selling is the same thing with other people. The product is not differentiated. They can brand switch when their needs are not met, or we charge ridiculous price, overpricing of our products. Another thing is, this relates to what we have done, when the cost of switching from one product to another are low. The product are sold the same price, 100 naira, 100 naira, 20,000, 20,000, or highest 20,000, 19,500, that's way. The switching cost is low. They can move to another one. Okay, number 5, competitive rivalry. That is rivalry among major competitors. The rivalry among major competitors is a factor to be considered by all existing companies. Even the new entrant that is just coming, we have to ensure that you consider the rivalry among competitors operating in the industry. Why? Because from the onset, I told you that the greatest enemy that we have is our competitors. Competitors are poisonous to our business. They don't wish us well. We have so many instances whereby the competitors with the market our products. Some of the competitors are producing similar products in a way to decline our profits. In some instances, they do it intentionally. So Competition within an industry is obviously also determined by the rivalry between the competitors. So the degree of rivalry among all existing suppliers, complaint sellers, is a factor to be considered. And what happens when the level of competition is high? Strong competition forces rival firms to offer their products to customers at a lower price, meaning that intense competition. In exam 2, they can use that word, intense competition, healthy competition can be used, cutthroat, C-O-T-T-H-R-O-A-T, cutthroat competition, that word can be used. Or rather, they use the word hyper competition. So this statement here informs us that strong competition, high competition, hyper competition, forces rival company to offer their product to customers at a lower price. That means competition in most times bring about reduction in price in an industry. Yes, it happens. Even in telecommunication industry. What we are enjoying now is a result of the competition. The emergence of Globalcom as a new entrance, and particularly the emergence of Etisalat that serve as a blessing in disguise for us. First price to reduce. So Porter now suggested that the level of competition can be strong in the industry. And when it is strong in the industry, it's first price to come down. This same scholar that was telling us that we should not allow new entrants to come in. We should not give room for them to bring in more competition. The same scholar that was informing us under this that high level of competition is good because it will generate revenue to the government. High level of competition is good because it will bring about lower price. He said rivalry among competitors is good because it will force the company to be more innovative and see to the satisfaction of customers. Can you see? So with that, we are done with Porter 546 model. So before we proceed to the third topic, may I ask you if Porter diamonds are, if strategic clock analysis is understood and Porter 546 model is understood. To recap, the strategic clock analysis is a combination strategy that employs the use of price and other strategy to create value to customers. If the customers already have perception of our product value, we can use that strategy to increase their perception, retain them, and win more customers. So the strategic clock analysis comprises of 6 strategies, out of which 5 are desirable strategies. The strategies are 1 o'clock strategy, number 1, no free strategy, 2, low price strategy, number 3, hybrid strategy, number 4, differentiation strategy, number 5, differentiation focus strategy, number 6, strategy that fails. Is that understood? So the number 1 to 5 strategy are strategy that we can use to achieve results and gain competitive advantage. But that number 6 strategy is a dubious strategy that is not good. Is that understood? And Porter said for any company that wants to use this strategy, you must understand and adhere rigidly to Porter's 6 principles. I'll spell out these principles for you. That our goal should be to invest on a product or services that will bring about high return on investment. We should not place unnecessary priority to sales volume and market share. He said there should be alignment of the value chain There should be trade-off. There should be continuity, synergy, and many more. So the second topic that we look at, we discuss about Porter 5 forces model. The Porter 5 forces model is the only model that we consider for competition analysis to know the degree or level of competition occurring in an industry, to determine how attractive in industry, how profitable it is, and the level of risks attached in the industry. So to analyze the industry, Porter said we should consider 5 forces, which are the threat of the new entrants, availability of substitute products, the leveraging or bargaining power of the suppliers, leveraging or bargaining power of the buyers, and rivalry among major competitors. Okay, that's the summary. I proceed to the next topic, which is Porter generic competitive strategy. Can I continue, please? My scholar, I don't hear your voice. Okay.
Yes,
Yes,
sir,
sir, you can continue.
Thank you. Bless you. I love that. The Porter's generic strategy. The generic strategies are strategies that companies normally consider for them to be able to operate and achieve results in whatever industry they have chosen to operate or in any market where they are selling. Irrespective of the nature of the products or services that we are producing, this generic strategy is applicable for all. So the generic strategy now comprises of 4 major strategies. And when you look at the slide that I share here, you will discover that the strategic clock analysis that we started with is an application of the Porter generic strategy. Why? Because these 2 strategies that you are seeing here, differentiation strategy and differentiation focus strategy, Bowman and Falkland, they borrowed this strategy to enrich their own strategy. That is their own strategic clock analysis. So what is Porter generic competitive strategy? This Porter generic competitive strategy equally gives company sustainable competitive advantage. And the most interesting thing is that company can use one strategy here. You can decide to use 2 strategies. You can use 3. And you can decide to use the entire 4, depending on your capability, resources, financial strength, the rate of corporate expansion. You can use 1, 2, you can decide to use all. We have companies that are using 4, the entire 4. Most multinational companies are using 4, except that number 4, a focus strategy that few of them are using. Okay, we start it. The generic competitive strategy comprises of the following. 1, a cost leadership strategy. 2, a differentiation strategy. 3, differentiation focus strategy that we already know the meaning. And 4, a focus strategy. The generic strategy, I put it to you again, are a cost leadership strategy, a differentiation strategy, differentiation focus strategy, and a focus strategy. Let me simplify it for you for better understanding. Very, very simple. Cost leadership strategy. Please, you can see this thing as a cost, and at the same time, I'm telling you tonight, you can as well see it behind, at the back of your mind, that cost, you can see it as a price. Why did I say so? Look at this. Cost leadership means being the lowest cost producer in the market. That is the meaning of the cost leadership. Cost leadership, it simply means being the what? Lowest cost producer in the market. Let me go further. Trust me, I will give you one line that will make you to understand it now. The least cost producer can compete effectively on price. Can you now see the reason why I say, see that cost as a cost, see it as a price? They said the least cost producer can compete effectively on price by offering his product at a lower price than rival products. It can sell its product more cheaply than competitors and still make a profit. And that's what we call a cost leadership. A cost leadership strategy occurs when a company offers their product at the lowest price in the market. It is possible they might be the only lowest cost provider in the market, or they are among the lowest cost provider in the market. So that means when they are counting number 1, number 2, number 3, number 4, before they count to 10, that company will be among the lowest cost provider in the market. Any company that have the motive, the objective of selling at the lowest price in order to gain leadership position in the market, they are the company that we call cost leader company. So a cost leadership strategy occurs when a company produce a product and sell it at a lower price. This strategy will give you opportunity to earn more profit at the long run. This strategy we call what we call go slow. There will be a pool of customers that will come to buy our product, particularly when the product is slightly below average or is an average product. So when a company sells their product at the lowest price, then they are using what we call cost leadership strategy. With this strategy, some of our competitors can even buy from us. All their customers will come to us and buy because of the cost reduction opportunity they have. So a cost leadership strategy can be achieved according to Porter when a company can fulfill some certain conditions, because he said it's an olden days strategy that is still applicable now. That companies are still achieving results, gaining competitive advantage through price. They are creating price war. So for you to achieve results with the use of cost leadership, what was the advice of Porter? He said, to achieve success, the company must embark on budgetary control. Any company that wants to use cost leadership strategy, your cost of operation, your total cost of operation must not be high. You must have strict budgetary control, avoidance of wastages. That is what we call lean manufacturing. He said you must have budgetary control. This one will bring about accountability. It will bring about financial discipline. I should not give opportunity for opportunistic behavior, misappropriation of the company's money. Second, he said the company should do backward and forward integration. That we want to use cost leadership and gain results, you must embark on backward integration. What do we call backward integration? Backward integration is a cost reduction and cost avoidance method in which the company will look inward, internally, the likely areas where they can reduce costs. Like one, the company can do what we call implant training of their staff. Instead of outsourcing their training, recruitment, this can be handled by the company. The company can have some level of control, reduce costs on their needed raw materials. How? Because in the backward integration, the company can acquire acres or hectares of land and plant some of their basic needed raw materials. Dangote is doing that. Unilever is doing that. When you go to Agbara, a lot of them have farms there. Internally, they are generating about 40, 30, 25%, or at times some are generating 50% of their basic raw materials. It is just only 50 they are buying outside. Even the 50 they are buying from the vendors, suppliers, if the price is high, they consider the importation of the products that basic raw materials. They can import it in order to save costs. That is backward integration. And forward integration. Forward integration occurs after production of the product. We are about distributing, selling to the customer. In our forward integration, we can reduce costs. Cost of distribution can be reduced. The number of middlemen or channel members that we use can be reduced, streamlined. Our promotional costs can be reduced. Our overhead expenses on labor, salesmen, whatever, can be reduced. And it said reduction of overhead expenses. We must not acquire too much staff. Rather than increasing our overhead expenses, the company can invest on innovative machines, production machines that can increase the production capacity of our products. When you go to Promasidor and the rest, you can see some machines that can produce up to 15,000 units of a sachet milk or whatever. Produce maybe 5,000 pieces or 10,000, not to exaggerate, pieces or sachet of paracetamol within 60 seconds. We automate our business activities and operational system in order to reduce costs. So the cost leadership strategy occurs when we sell our product at a lower price in order to gain competitive advantage, when more customers make more profits. So in that industry or market, we are challenging, competing offensively, using price as a weapon. So to be able to use this thing and achieve favorable results, we must reduce our cost too. That should be budgetary control, strict internal control, that should be backward and forward integration, reduction of overhead expenses has to be done. Secondly, we have differentiation strategy that we have talked about. We need not waste time on this. In the differentiation strategy, we produce a unique, standard, and differentiated product. This product must meet the needs and wants of the customers. And for us to gain advantage on the differentiation strategy, the customers must truly perceive it as something different. It might be different in time of taste, different in time of mode or time of delivery. It might be different in time of convenience. We can use anything to differentiate our products. And once the customers perceive the product as truly differentiated, what did I inform you? The customers might be willing to pay a high price. That high price is what we call premium price. The high price is what we call premium price. And they are paying that premium price because that product is truly differentiated. The third strategy under the generic strategy, which was borrowed by Bowman, is differentiation focus strategy. Under this, the company produced a unique standard and differentiated product and sell to specific class of customers at a premium price. It's not for the entire market. We create a niche for this particular product. The fourth one is focus strategy. Focus, F-O-C-U-S, focus strategy. Anywhere you see a focus strategy, just know that a focus strategy is a strategy that company adopts when they decided to concentrate. If you don't use the word concentrate, repeat that same word, focus. When the company decided to concentrate or focus on a particular narrow segment of the market. Because mostly in focus strategy, some of the small and emerging companies, they use more of focus strategy because they don't have the financial capability and strength, the competitive strength to follow all the opportunities that are available in the market. Instead of that, they will create a niche. Create a niche means that they will look at the entire market and look at the narrow segments, small segments. That's what I mean by narrow segment. We call it narrow segment, we call it or small segment. they look at the smaller segment of the market where their available resources will permit them to satisfy the needs of the customers in that market. So under focus strategy now, rather than running after the entire opportunity in the market, the company will decide to carry out a marketing research, identify the customers in a particular smaller part of the market, discover what are their needs, how can this need be met, do we have the resources to satisfy this need? Once that one has been discovered, and the company have the resources to satisfy their needs and make a profit, they will now concentrate on that smaller number of customers. They will concentrate on them and push their products to those customers. Because the market is small, because the number of customers they are dealing with, they are smaller, this will bring about more understanding of the customers. It promotes reciprocal relationship with the customers too. So they'll be able to interact with the customers, serve them more better. Because the market is small, majority of the large conglomerate organization, they neglect that segment. They see that the profit in that segment is not too high. So this one will give companies that concentrate on a small market opportunity to stabilize, achieve survival, and going concern. So anytime a company focus on a small segment or part of the market due to the limits of their capability, resources, competency, and and the number of customers they are able to serve, that is what we call focus strategy. So a focus strategy means concentrating, selling your product and services to narrow segment of the market. Any example can be cited is that the other time that we cited example of what's it called? An investors that invest into education line. They have polytechnics, they have secondary school, they have boarding school, they have primary school, they have crèche. So we, equity, that is just coming to the industry for the first time, we don't have the capacity to engage in all these different educational setup. So rather than forcing ourselves, subjecting ourselves to unnecessary risks, to mitigate against risks, and for us to gain relevance in that industry and penetrate the market, we start with crèche. That's the focus strategy for us. So many companies, depending on their specialization, the limits of their resources, they decided to use focus strategy to gain survival and relevance in the market. So the next thing, we look at vision and mission statements under organization purpose and strategy. Mission and vision statements. The mission and vision statements during the era of CSME is a regular customer that comes out after 2-3 diets. At times I can reset it again. But now that we have this part merged with SFM now, the way our manner is being set might be quite different. And this is a topic that I know they can just use it to give us a preamble about a company, but we never can tell. It's very difficult to predict. There's some diet that we might be fortunate that the questions will be simple. And that's one reason why we don't have to neglect it. Ordinarily, some facilitators might just feel mission as vision statement is not necessary. So no like is lost is an added value. What do we call mission statements? I'm not expected to waste time on this. A mission statement is the purpose of an organization. What did I call it? I said a mission statement is the purpose of an organization and the reason for its existence. purpose of an organization, and the reason for the existence of the company. It is a formal and public statement that shows the blueprint and deep intention of the company. You can see, it is a formal statement. And it is a public statement because it is for the consumption of the entire public. It's not an hidden statement. All the shareholders, stakeholders, the host community, potential customers, existing customers, the government, the host community, the society, the media, everybody must have access to this. And the more reason why you go online, using any of the search engine, Google Scholar, Google, the normal Google Scholar, Ebisco, just use it to search the vision and mission statement of any government agency, any company. You will see it online. It's a public statement. And it shows the blueprints of the company. It shows the intention of the company and how they intend to impact positively in the life of the entire public. So mission statement always describe the company basic functions. It is the mission statement that will tell the public the product and services the company produce and how they intend to satisfy and create benefits to the customers and the entire public with their product and services. The mission statement that we are talking about, it describes what the organization does. That is their present capability. Who it serves, that is the stakeholders. And what made the company unique, their reason for existence. So the mission statement of one company is always different from another. The same with vision statement. Because we cannot copy. If I thought you come across a vision statement and you want to draft your own, you can just adapt it. You paraphrase. That's the one reason why I said the mission statement differentiates an organization from others by explaining its broad scope of activities. Our competitive scope will be explained by our mission statement. And with that, we must ensure that our mission statement focus on the limited goals. When we are drawing our mission statement, we should not make it to be too lengthy, 2 paragraphs, 3 paragraphs, no. Even some might not be more than 200 words. It should be concise and focus on specific objectives. So mission statements answer the following questions. I've informed you, a mission statement should be clear and short statement, meaning that it should be concise. Peter Drucker suggested that a mission statement should answer the following fundamental questions. So what are the questions that the mission statement answer? 1, what is our business? A mission statement should clarify this. 2, what is our value to the customers? 3, what will our business be? 4, what should our business be? So these are what we call a mission statement. So in a way, we can summarize it that a mission statement is the blueprint of the organization. It comprises of the company philosophy, core values, and goals. So what are the basic features or characteristics of vision statements? The basic features and characteristics of a vision statement are: 1, a mission statement must be feasible and attainable. You must not just write anything that is ridiculous, ambiguous, that is difficult to achieve. 2, mission statements must be clear for better understanding of all the stakeholders, shareholders, investors, and the public. Number 3, C, our mission statement will be inspiring for the management, staff, and the society at large. Number 4, I've mentioned that in the course of explanation, that our mission statement should be precise enough. It should neither be too broad or too narrow, but it must focus on specific goals, specific and important goals. Again, our mission statement should be unique and distinctive. So the characteristics are not limited to that. Please take note of that. So the next thing is to look at vision statements. And this vision statement normally comes first. A vision statement. A vision statement identifies where the organization wants or intends to be, or where it should be, in order to meet the needs of the stakeholders. A vision statement, look at this statement. A vision statement identifies where the organizations wants or intend to be in the future. If you don't want to put it this way, let me just give you one word, one sentence that you use. That sentence is that a vision statement is the destination of the company. That is the meaning. A vision statement is the destination of the company. That means it is the future of the company. That's the reason why we said both vision and mission statements, they are futuristic statements. They discuss about the future of the company. Because a vision statement is the projection into the future, where the company wants to be and what they want to achieve. So vision statement, it is the destination of the firm, and what? It is the dream and aspiration for the future. Vision statement is the dream of the founder, what they want to achieve. For instance, Microsoft vision is to empower people through great software, anytime, any place, and on any device. Are they not achieving that? They're achieving that. What is the vision statement of this company, Walmart? The Walmart vision statement is to become worldwide leader in retailing. So what are the questions that the vision statement answer? The vision statement answer the question where we want to be. It gives us a reminder about what we attempted to develop, so that we will not forget our aspiration or future goals. So the same attribute, features, characteristics that mission statement share is what the vision statement too have. Both of them, they share the same features and characteristics. You can see the attribute, features, and characteristics of vision statement. It must not be ambiguous. That means it must be precise or simple. It must harmonize with organizational culture and value, meaning that your vision and mission statement must be in consonance, in agreement with the culture, value, and philosophy of the people. It must not disagree with it. Any investment, be it merger and acquisition, diversification, or whatever, expansion of portfolio of investment that contradicts or be in disagreement with the official mission statement, you must not accept it. So let's proceed. Goals and objectives. By now, you should be able to differentiate between goals and objectives. The goals are desired future, the desired future state objectives that the company wants to achieve. So the goals, they are always long time in nature. They are futuristic too. And these goals are being drawn in alignment with the mission and vision statements of the company. So it is this goal that will create a pathway for achievement of our desirable vision and mission statements. And we must know that a well-formulated goals must have the following features. Well-formulated goals must be precise and measurable. A goals should look after critical and significant issues. That means before we set a goal, we must check it holistically. What are the critical areas of investment or concern or priority? So our goals too must be realistic and challenging. But when it comes to objective, they are specific and lay down areas of achievement that the company wants to gain, be it in the short time, medium time, or long time. But the most important thing that we must know about objective is that any objective that the company is setting, even as individual, the objective that we want to ratify or adopt must follow the framework of SMART, SMART. Our objective must not be set outside the SMART acronym or framework, meaning that our objective must be specific or stated clearly, that is X. Our objective must be measurable, that is M. Our objectives must be attainable, that is A. Our objective must be realistic. It must not be too ambiguous, because by the time the objective is too ambiguous, it will create internal tension or disequilibrium. And this might push some of the our staff to engage in unethical practices that can drive the image of the company into disrespect. So the objective has to be realistic and it must be time-bound. You must have a time frame within which we want to achieve our stated objectives. What are the significance or importance of the vision and mission statements? What are the significance? The significance of the importance of the vision and mission statement is that it instills sense of purpose and belonging to the organization. Everybody will identify with the company vision and mission statement. They'll be able to know the company philosophy, the company core values, the ethical standard of the companies, and collective responsibility. Another significance of the vision and mission statement is that it will create a pathway through which corporate objective, structure, policy, and procedure are being set. Both vision and mission statements, they serve as a focal point for individuals to identify themselves with the organizational process and to give them a sense of direction. There are many advantages of vision and mission statements that I've put there. The question is, who decide mission and vision statements? The mission and vision statements, they are being decided by the leaders of the organization. And what I mean by leaders of the organization, yeah, you and I know that those are the strategic apex. Because Henry Misbah called them strategic apex. Those are the CEOs, the board of directors, the shareholders. These are people that come together to determine the company vision and mission statements. I think that is understood. Okay. So we quickly look at the last aspect of the topics that we are looking at today, which is the levels of strategy. Levels of strategy. Levels of strategy. So the level of strategy is usually used to analyze strategy into hierarchy of different levels. That means the level of strategy gives us opportunity to categorize strategy into different levels. That's what I mean by hierarchy. Maybe stage 1, stage 2, stage 3, level 1, level 2, level 3. You understand? This word hierarchy, there are words that we are used to. So it is usually used to analyze strategy into hierarchy of different levels. And this hierarchy of different levels, there are no more than 3 as far as level of strategy is concerned. So in exam condition, please listen attentively. We might be required to discuss on the level of strategy based on Johnson, Scholes, and Whittington, because they are the scholars that discuss and formulated the level of strategy. Even their name at times in some questions, they are being abbreviated, or they might write the name in full and prove the abbreviation in front. But in accordance with Johnson, Scholes, and Whittington, discuss critically on the level of strategy. Johnson, Scholes, and Whittington, they will abbreviate it as J, S, and W. So the level of strategy are divided into 3. We have 1, corporate level strategy. 2, business level strategy. 3, functional strategy. There are 3 levels of strategy: corporate level strategy, business level strategy, and functional strategy. So you can see it that they are in hierarchy when you look at this diagram: corporate level, business level, and functional level. So the corporate strategy, that one focus on what business should a company invest in? What business should we invest in? The business level strategy, that one talks on how should we compete in this selected business. That means if we have identified the business and the industry or market to operate, how are we going to compete? Which strategy are we using? That's what the number 2 is talking about. In number 3, functional strategy. The functional strategy is saying that for each business function, how can that function contribute to the competitive advantage of the company? So the functional strategy is saying that what should be the contribution of each department, each unit, or each of the SBU manager, strategic business unit manager, the employees, what should be their contributions? Okay, we quickly look at them one by one. It's not a complex area. Corporate strategy. The corporate strategy is concerned with deciding which business or businesses an entity should be in and setting targets for the achievement of the entity overall objective. What business are we to invest in? What industry are we to operate? What are the goals or objectives to be achieved? How can this objective be achieved considering the resources we have at our disposals? These decisions are taken by the board of directors of the company. The corporate decisions are not taken by functional managers or lower level managers, no. So what are the elements of corporate strategy? The elements of corporate strategy comprise of the following. 1, deciding the purpose of the entity. The purpose. Why is the entity in existence? Why are we in existence as a company? What is the mission and vision statement? And what are we trying to achieve? That's the meaning of deciding the purpose of the entity. 2, another element of the corporate strategy is matching the chosen business activities to the external environment of the entity. We should be able to analyze our business environment. That was our first topic. Any company that fails to analyze its business environment, both internal and external, such a company will experience declining performance. The company can be static in terms of growth. And that company might experience premature extinction, death from the market. Because no organization can achieve results without interaction with their immediate environment. So we must match our business industry, our resources, competencies with activities in the business environment. And in that number two, too, based on the topic that we have looked at tonight, that is Porter 546 model, we should be able to analyze the degree of competition in the market or the industry where we want to operate. What are the government regulations? All these things should be considered in the number two. Another thing that we have to do anytime we are discussing about corporate strategy is matching the purpose and activities of the organization to the expectations of the owner. Who are the owner of the company? The owners of the company are the shareholders of the company. But they are the ones that invest, they manage and finance the company. And the expectations are to be met. Some of the expectations of the shareholders are high return on investment, prompt dividends, competitiveness, goodwill, diversification of investments, low staff turnover. These are some of corporate disclosure and engagement of the shareholders. All these has to be met, and it must be factored in anytime we are deciding on our corporate strategy. The next strategy is business strategy. The business strategy is also called competitive strategy. It is concerned with how each business activities within the entity contribute towards the achievement of the corporate strategy. So without our business strategy, each functional manager, they have a role to play. Each strategic business unit and brand manager, they must have a contributions too. That's the more reason why in some companies, they have branch manager, strategic business unit manager for each of their products or product portfolio. That means the success and failure of that product lies on that person because you'll be held accountable. Under the business strategy, Michael Porter gave us an advice. And what was the advice? According to Porter, a successful competitive strategy must be based on cost leadership strategy or differentiation strategy. He said, under the business strategy, he advised that company, when you are thinking of your business strategy, you can consider the use of cost leadership strategy and differentiation strategy that we have discussed about. The last functional strategy is, the last strategy level is functional strategy. The functional strategy is the strategy that is adopted to bring immense contribution, valuable contribution from all the functional managers, among which are the marketing manager, production manager, finance manager and unit, HR manager, because all of them must work collectively towards achieving the same goals and objectives. But their own contribution too is vital. No department can single-handedly work and achieve the overall goals and objectives of the company. There should be integration of functional activities and synergy among these various functional managers and departments. So lastly tonight, we look at levels of planning. Level of planning. And that level of planning, that's just the basic knowledge that we have to know. But I can guarantee you at this level, no examiner will ask you to identify and explain the various level of planning. You get it. Rather, they can use the knowledge gained here to formulate a very robust question to now know if the company, they approach their different planning procedure in a very good way, to know if the companies are proactive enough in their strategic approaches. That's what this level of planning is all about. Because the level of planning, be it we name a scholar or not name a scholar, that according to Anthony, Anthony identified 3 levels of planning within an organization, which is strategic planning. And I've told you strategic planning is futuristic, deciding the goals will be achieved in the future, preferably between 5 years and above. That of tactical planning. Tactical planning are short-term plans for achieving medium-term objectives. Example is annual budget. But when it comes to operational planning are often day-to-day activities, operational activities that is directed towards achieving some specific goals. That is operational planning. So all these approaches to strategic planning is based on be it is operational planning, strategic planning, or tactical planning. So what are the approaches to strategic planning? There are 3 approaches to strategic planning too. 3 approaches to strategic planning without cramming anything. We have 1, rational planning approach. 2, we have freewheeling, opportunistic model. And 3, we have logical incremental model. You must not forget this, because you can use this one to express, to make a point, justify some important points that we have made to convince the examiner in the exam. Maybe probably the strategic manager or CEO or the board of directors are not rational enough. This is where we get all these words from. So rational planning model or approach. Under the rational, we call it rational because there are major changes in the strategic approaches. We call it rational because there is going to be a critical analysis of the strategy to be adopted, formulated, reviewed, and implemented. And anything radical strategy require holistic changes in most time. Okay, let's look at the note. Rational planning model. The rational model of strategic planning is a top-down and formal approach to strategic planning. Top-down means that it is not a decision for the junior staff or lower level staff or manager. Top-down is a decision that is taken at the top, and that decision will be communicated down. That's the reason we have it that it's a top-down, and it's a formal approach, not an informal approach or subjective approach. It's a top-down, objective, and formal approach that is taken by the board of directors of the company. Is that understood? So, a formal strategic plan is prepared at the senior management level. I've mentioned that, covering a period of perhaps 5 to 10 years. Why do we call it rational? It is called rational model because it is a logical planning and management process that go through logical processes of position analysis. You can see, in our rational model, we have to do position analysis, marketing audit. What is our competitive position with other companies? Are we among the market leader, market challengers, market followers, or market niche? Position analysis require SWOT analysis, SWOT analysis, TAUS analysis. Our rational planning model will require making strategic choice from options available. We have different strategies. Which one will give us the best results within the year stated? Rational planning also involves implementation of the switching strategy and constant evaluation. That is what we call rational planning approach. The number 2 strategic approach is freewheeling opportunistic model. Freewheeling. We call it a freewheeling because the company here, they don't have a specific laid down strategic approach they want to use. The major approach they use here for survival is that, depending on the situation in the market or in the industry, depending on the threats that the company is facing. It is the present threats or challenges that they are facing that will indicate the type of strategy that they are going to use. And this form of strategy is not good. Though we discovered that the business environment is uncertain, we cannot preempt everything that can occur. There are some unforeseen circumstances that will occur that the company has to quickly maneuver, find a way to adapt or overcome it. But there should be a laid down strategic plans, because under the freewheeling, look at it, a freewheeling opportunistic approach to strategic decision making is that there is no requirement at all for formal strategic planning. It's like building a company now. We have a company, we have invested so much in building our branches and company. We don't even make provision for fire disaster. No single fire extinguisher. So when fire now comes, we start running up and down. An organization should be open to seeing new opportunities whenever they arise and exploit them. Then we should make provision for what strategy can we use to identify and exploit business opportunity. Because in some freewheeling, some companies are boosting that they use what we call a dancing strategy. They'll be experimenting strategy. What do you think we can do? Call me Mr. Thomas. This situation at the memo that comes. What's your own suggestion? But when it's come to logical incremental model approach, a logical incremental model approach, this field of strategic planning is that effective strategy emerge as a series of strategy for subsistence within the organization, one at a time, and not part of an overall coordinated plan. Can you see? Under the logical incremental approach, this approach or strategy that we are implementing here, they are not part of the overall coordinated plan. But as we are reviewing our strategy, evaluating our performance, evaluating the threats, identifying opportunity, we are bringing more robust strategy that we can add to some of our existing long-term plan. That's the reason why we say they are not part of the overall coordinated original formal plan. But they are the strategy that we put in place to enrich our strategic plan, gain more opportunity, expand, gain sustainable competitive advantage, make more profit. Because we need to sustain. It is one thing for us to achieve high profits year 1, year 2, year 3. If we cannot sustain it, there is of no use. That strategy cannot stand the test of time. Your strategy must be valuable, must be rare, must be organized, must be highly inimitable. That is costly to imitate. And any strategy that we are using to gain competitive advantage must give us a long-time advantage, not just short-time advantage or monthly or yearly advantage. No, it must be sustainable. So this is where we are going to end our lecture tonight. Thank you so much for your commitment and efforts. Any question, please, before we call it a day, and we shall a joyful night rest. And I hope what we did today is understood. So by the time you are going through it, going through the video and the material, I pray God will give you the spirit of knowledge, enriched knowledge. Okay, in view of no question.
Good evening, sir.
What is it, sir?
No, I wanted to add, is your contact on the platform? So that because I have some question, but it might not be on this platform.
You can send it to me. You can send it to me or put it on the platform so we can look at it.
All right.
Okay, sir.
Thank you, sir.
Okay, I wish each and every one of us happy night rest.
Thank you, sir.